Chief Global Market Strategist at Invesco. Christine, it's always great to see you. Any thoughts on that inflation news?
Well, John, it's always great to see you, and especially so on a day like today. I think it's fair to say markets will be, and I certainly am happy with the CPI print. We're never going to get a print, or we're rarely going to get a print that we're thrilled with. But this shows that progress is being made and that we're moving in the right direction. Not every single data point is going to show that trend, but overall, that's where we're moving, and that's really the important thing. What we learned from the Fed last week was, in my opinion, they are instituting a de facto conditional pause. The language was not that different from the conditional pause that the Bank of Canada imposed in January, and it was very similar to the language we saw back in 2006 when the Fed hit the pause button on hiking rates. So that means that every single data point, especially inflation-related data point, I should say, has more importance. And so all eyes were on this. There were jitters yesterday because rumors started flying that it was going to be a hotter than expected inflation report. So I think everyone's going to have a sigh of relief today and be pleasantly surprised by this.
So I guess there's the short term and then there's the longer term. And from a lot of the pundits we hear from these days, there's some complicated long-term questions. I saw the Apollo economist Torsten Slok put out a note that highlights some of the findings from this week's loan survey from the Fed. And after the collapse of Silicon Valley Bank, we've seen credit conditions tightening. And then when you combine that with inflation, better than expected today, but still well above the Fed's target, which could mean rates are going to stay high, even if there is some kind of pause. Slok is predicting there could be a recession that is deeper or longer than consensus when you just put all these factors together. How are you thinking about where the economy heads from here?
Well, my base case is that we would see a far more modest downturn. If it is a recession, it would be a mild and rather brief recession. But there always is the potential that we could see something worse. Let's face it. We had a very, very aggressive period of tightening, and it was a brief period in which we saw so much aggressive tightening. And there is a significant policy lag. Typically, we expect 12 to 18 months before it shows up in the real economy. And so we're just seeing the tip of the iceberg. Having said that, though, I think this is a very resilient economy. And first and foremost, in terms of my argument for why it's so resilient, is the job market. It's a very tight job market, and it appears to continue to be rather strong, despite the kinds of layoffs we've heard about and the tightening of credit conditions. Do I think credit conditions will tighten from here? Absolutely. But that is also a bad news, good news story, because that also stacks the deck in favor of the Fed not hiking rates again.
And staying with a balanced conversation, well, the last chart that we showed our audience speaks to some of the uncertainty out there. Technology stocks, some of the growthier names in the market to this point, have outperformed just about everything in 2023. And so for investors who are trying to figure out where we go from here, I hear all the time about people saying, be cautious, be defensive. Had you done that coming into this year, you'd already be lagging in terms of overall returns. When you think about portfolio positioning, are you looking for both some safety, but also some access or exposure to growth?
Well, it all depends on how you define defensive, because I would argue defensive positioning means defensives like utilities and healthcare, but also secular growth like technology, or at least the large majority of industries within the tech sector. So if you had been positioned that way, I think you would have done well this year. And I would argue that defensive positioning going forward should include technology. As growth becomes more scarce, secular growth becomes more attractive to investors. And I think that that's how investors should be positioned going forward, is more defensively. I would anticipate, though, at a certain point, and it could happen in the next few months, markets start to discount an economic recovery. We would have to be certain that many of the issues, the uncertainty facing markets today, are largely in the rearview mirror, like the debt ceiling. But I think at a certain point, we will see a turn to a more risk-on, more cyclical market environment.
Okay, and before I let you go, we had for our television audience just a board with some of your ideas, which included some of those secular tech names and healthcare names, but also leaning into companies that are committed to dividend payments. And that's within those sectors, right? That's not necessarily looking for, I don't know, consumer staple stocks that have nice dividends. It's looking within those other sectors for dividend payers.
Historically, they've exhibited lower volatility. And an environment where we have a lot of uncertainty, it's the debt ceiling, it's the Fed, lots of things going on. For those investors that are interested in lower volatility, this could be one way to achieve that.
Okay.